Okay, so we are going to pick up where we left off on Tuesday oh, I'm sorry, Sarah, can you shut the lights off for me, please? On talking about elements of gross income. And I think as far as we got was we just talked about wages, and then we were talking about interest and dividends. Was everybody comfortable with that matrix I put up on the smart board as far as what's taxable, what kinds of interest are taxable for state versus fed? Okay, if you did you have a chance to listen to the lecture? Then make sure to get a snapshot of that matrix from somebody, because different kinds of interest are taxable on the feds versus the state. Okay, let's see how much you guys remember. Is interest where is interest from a St. Petersburg, Florida water bond taxable? I got a check for $800. I'm invested in a St. Petersburg, Florida water bond. Is that $800 taxable for the feds?
No.
No. Is it taxable for Montana?
Yes.
Yes. Where are you going to see that on your Montana manual recap?
In the additions.
You're going to see it as an advent. I have invested in a Harleton, Montana road bond. Is that taxable for the feds? No. Is it taxable in Montana? No. Do I need to enter it into software anywhere then? Yes, because it goes into other calculations that you don't know about yet, but you will, and we need that number in there. I invest in some EE bonds with the feds. Taxable for the feds?
Yes.
Yes. Taxable on Montana? No. Federal bond interest, taxable on the feds? Yep. Taxable on the bond, on the state? Nope. So that's what part of your recap? Subtract. Okay. Dividends. Oh, and I'm sorry, let's just one more time. What document am I going to get that's going to show that I've got bond interest? A 1099 INT, correct. Okay. Oops. No. 1099 INT. What do you get when you are going to receive dividends, or when you have received dividends? You get a 1099 DIV. There's three kinds of dividends, and on your 1099 DIV, it's going to tell you. There's a bunch of boxes. It's going to tell you whether it's ordinary, non-taxable, or a CGD. And it's not as important to me that you know what each of those are, is that you know where they go on your tax return. So, and I don't know what the box numbers are, but let's say in the ordinary dividends box, you have $1,173. Next to it's going to be a box that tells you how much of that is qualified. That's not in addition to the 1173. That's what portion of the ordinary dividends are qualified. Qualified means that they're taxed at capital rates. So the 979 of the 1173 is taxed at that 20, 15, 10, or 0. Again, making it tricky to calculate the tax, right? You can't just go to your taxable income and say, oh, go to the tax tables.
Can you say that one more time?
Sure. So your qualified dividends are treated like capital distributions, meaning that they're taxed at those lower rates, 0, 10, 15, or 20, depending upon what your regular income tax rate is. And we'll see that in a second.
Can you repeat the second half?
Sure. So your qualified dividends are going to be taxable at capital rates. And it's not important that you write down the rates right now because I've got a slide coming up that shows that.
So are the ordinary taxed at,
Ordinary rates.
so the, like the
The
$200,
difference,
the
yep.
$200 difference would
Precisely.
be taxed at
The
that higher rate?
ordinary rates. So if I'm in the 39.6%, the difference between these two numbers is taxed at my highest marginal rate. And these guys are taxed at lower rates. Just like capital gain distributions. CGD. These are reported on page 1 of the Form 1040, where it says capital activity. Or if you have other capital activity, like I bought and sold other stocks and bonds, it goes into Schedule D. So process what I'm saying here. If I've got a lot of capital activity, I buy and sell bonds, I buy and sell jewelry, I buy and sell antiques, I buy and sell property, I'm going to have to fill out Schedule D, right? Because I've got a lot of gains and losses. If on top of that, I have some capital gain distributions or some qualified dividends, those will go on the Schedule D with everything else. But if I don't have anything else and all I have is capital gain distributions or qualified dividends, then it's just going to go right on the face of the 1040. It was kind of like we learned on a Schedule B. If I've got over $1,500 of interest, I've got to go fill out the B. But if I've got $18 of interest, I still pay tax on it. I just don't have to go do the B. Does that make sense? Here's the table. If I'm in the regular tax bracket of 10 to 15%, I pay 0 on my qualifying dividends. If I'm in the 25, 28, 33, or 35% brackets, I pay 15%.
Does that dividend include your overall?
So let's try this. So in this example,
Yeah.
how much is going to be taxed? And I'm in the, and I'll have you guys look this up. My TI. Let's just try this. I'm married filing joint, and my taxable income equals $392,415. I'm a doc. I'm an oncologist.
But what I mean is that dividend included in that total amount?
That's where I'm going to. Yep. So is it? Is that $1,173 going to be in my TI? It is. It's going to be on line. Let's go see if we can find where we think dividends show up on our 1040. And I think we were using page D11. I'm sorry, go ahead. Yeah, line, I think that's 9A, isn't it? Okay, line 9A. What number is going to show up there? The whole amount.
Oh, the whole amount.
But look what goes in 9B. 973. Now, I want you to go to the, so let's go back to the question. Is the 1173 included in the 392,415? Sure. Go figure out my tax bill. We'll do it together, but get to the tax tables. Stacy's looking at me like that's not going to happen. You need to walk me through this. Okay, let's go to the tax tables. Page A-2. First off, which tax table am I on page 8-2? Yeah, section B. What's my highest marginal tax rate if my adjusted gross income is 392,000 and I'm married filing joint? Yep, so what's my highest marginal tax rate? 33%. Does everybody see that? Therefore, what percentage are my qualifying dividends taxed at? Now you have to go up here and look at this table. Yeah, since my highest marginal tax rate falls here, my qualifying dividends are taxable here. Now, everybody with me so far? What do I have to do with this 392,415 then? Can I just take it straight to the tables? No, I can't take it straight to the tables because a small piece of it is going to be taxable at what? 15%. Can you figure it out now? Okay, I'm going to give you a couple minutes and I'm going to try and reboot the smartboard so that I can see if I can use that. So I prefer to capture it on the smartboard. So basically what they tell us here, or what we know here, is that we've got to split our taxable income into two chunks. The $979 of qualified dividends is taxable at 15%, so we pay $147 on it. Okay. The balance, $392,415 minus $979, tells us that $391,436 of income is taxable at the regular schedule, right? And what that tells us is the math is take your TI times 33% and then subtract 24,471, right? So it looks to me like that number is 24,471, 104,703. So my total tax,
104.
yep. And here's the pitiful thing, when you have clients that have tax bills like this, all you hear about is how much I pay in tax. It's like, dude, you made as much as the average family in Montana does in a decade. Of course you pay a lot of tax.
I guess if I made that much money though too, I would complain about a third of my income though.
But, okay, the other thing is, and you know this,
Yeah.
is this number a third of your income?
What's that?
Is that 392 a third of your income?
Oh, that's just the taxable.
Right, yeah. You've got your
Oh,
exemptions minus your deductions, and when you make that kind of money, your mortgage interest is probably 40 or 50 grand because you have a $500,000 house. So it's not even a third of your
It's
income.
not.
Not even
You're
close.
Right, you're right. That's just a third of the taxable.
How did you come up with the 104,850?
Is the 104,703, did you come up with that number?
104,700.
Yeah.
Yes.
Did you come up with the 147 for the qualified dividends?
Yes.
Sure, so you just
Just
add them
add it.
together.
Okay, I thought you said subtracted, so I'm trying to.
No. Sorry, I was adding right to left, which is a little confusing. Okay, cool. Let's keep moving on. Alimony. Alimony is deductible to the payer and taxable to the payee. Let's go to page D11 and see where our alimony flows through, please. If I'm receiving alimony, what line does it show up on as taxable to me?
11.
Line 11. If I'm paying alimony, I'll tell you it's a deduction for AGI. Where does it show up? I think 31A.
Oh, yeah.
And what do I have to put in?
The life or the.
Yeah, the social security number of the person I'm paying alimony to, and guess what? The IRS is going to make sure that he or she shows it on line 11. Because if I'm paying you $2,000 a month as my ex-husband, that 24 grand better show up on your tax return. Okay.
Right.
Yep. It's got to meet these 5 requirements. It's got to be in cash. In other words, I can't be paying alimony and, non-cash items like cars or motorcycles. It's got to be made in connection with the divorce decree. It can't continue after the death of the ex-spouse. It can't be designated as anything other than alimony, and you can't still be living together and one person write it off and the other person tax it, because that's income shifting, not allowed. Other issues with alimony, I'm not going to go too deep into this.
Quick question. about
Yep, go ahead.
alimony.
Yep.
On Montana, is that the spouse compensation?
No,
That's different?
that's different. Let's take a quick peek at this. So complying with the 2015 written divorce decree, Frederick pays Shauna $1,800 a month. The decree specifies that that the payments will be reduced 40% when their daughter becomes 18. Do a quick calculation and tell me how much Frederick can deduct in any given year for alimony while the daughter's still under 18. How much can Frederick deduct on line 31A for alimony?
Until she turns 18.
Right, but it's 40% of its child support. It's not alimony at all. So that's what you have to pick up from that. if it's contingent on something other than just paying it, then you've got to kind of dig in and say, is it really alimony? No, 60% of this is alimony, 40% of this is child support.
So 720 of it's child support.
Right. So 1,800 times 0.6 gives you how much per month is the alimony. Then times 12. One more time. I think it's 12,960, isn't it?
So I take 10
Yep. Because I think like 1,080 a month is alimony.
Yep.
Times 12 months.
details.
Huh?
Oh, details.
So many details. Tax is all about details. Is it starting now to make sense? Remember the first day I said that they gave a case to 50 CPAs in 50 states, and not one single tax return came up with the same answer?
Jeez.
That's how convoluted our tax law is. It's 1,000,000 pages. Child support. Child support is not deductible to the payer. It's not taxable to the payee. And if you are liable for both alimony and child support and you get behind, you've got to catch up on your child support before you can deduct any alimony. Prizes and awards. When you get a prize or an award, it is fully taxable. So say you call up K-Pax and you win the trip to the Gorge to see Dave Matthews for Labor Day. All expenses paid, tickets, gas, camping, blah, blah, blah. $1,000. Guess what you're going to get at the end of the year? You're going to get a 1099 MISC, a 1099 miscellaneous. There's actually a box on it for prizes and awards. That $1,000 is fully taxable. Okay? You go on a game show and you walk away from, The Price is Right with a $40,000 RV. Guess what you're going to get at the end of the year? 1099 miscellaneous. You got 10 grand to pay tax on your new RV? Well, maybe, but maybe not.
Then you'd have to sell it.
Maybe not. Now I'm selling the RV to pay the tax on it. Okay? That's not the common occurrence. The common occurrence is you get it through your job. Like, oh, great, you're the top salesman this month, Stacy. This year, you get a trip to Cancun. You're going to get 1099 for it. The only exception is if an employee is given tangible personal property. What does that mean? Tangible means something you can touch. Personal means it's not real estate. You get a watch. You get a cell phone. That's probably more common these days than a watch, right? You get a new iPhone. Okay. You can exclude the value of it up to $400 if you got that prize for length of service or safety. You've been here 20 years. Here's an iPhone. Or you performed, you had an exemplary safety record in the plant this month. Or if you've got a qualified plan means you've got a written plan that's compliant with the Internal Revenue Code, you can exclude up to $1,600. So these are really the key things here. Up to $400 or up to $1,600 if you have a qualified plan, but only if it's a tangible personal award for length of service or safety. So this guy, Joseph, he's an employee of Vesuvius Statuaries. He received a clock for 20 years of service valued at $1,500, like the big, beautiful desk clock. The award is not considered a qualified plan award. How much is excludable from Joseph's gross income? Can he exclude the whole $1,500? No. Can he exclude any of it? Yeah, because it's for length of service, right? So 1,500 minus 4, he can exclude $1,100. No, he can exclude 400, and he's got to include 11. All right, put on your thinking caps here. Annuities and pensions. Anybody able to define what an annuity is or have a vague idea of what an annuity is?
Is it when someone passes away and then leaves their money for a certain person for so much years?
It could be. It could be. The key to an annuity is just what you said, is that you get a set amount every month, every quarter, every year. I think you studied about it, you're all in manager. Anyways, it's also used for pension calcs. In the context we're using, I'm going to be studying it here, and it could apply for a beneficiary, as Amanda just said, but the way we're going to be looking at it here is, I work all my life, I save $300,000, I retire. What are my choices? I've got that 300 grand sitting in the bank. What's your first concern? Is it going to last me? My mom died at 93. I've got a 101-year-old aunt still alive. My grandmas both lived until their late 90s. Is this money going to last me? That's my biggest fear. Looks like a lot of money, but you got 30 years in front of you where you got no other income coming in. Is that going to last me? So I've got two choices. I can self-manage it, or I can take that 300 grand and I can give it to my friend Katie, who sells annuities. And I give her my 300 grand, and we do some calculations based on interest rates and projected life expectancy, and she cuts me a check every month for the rest of my life. If I live to 120, I get that same check. If I get hit by a bus leaving there, signing the papers, that 300 grand is gone, and my kids get nothing. You with me? So the risk,
It's like a gamble.
it is a gamble, but it's also a gamble. Is that 300 grand going to last me the rest of my life? I just helped my sister go through this. My sister just retired a couple years ago. What we ended up doing, or what she ended up doing based on some research we did, is she kind of went halfsies. She's managing half of it on her own, and she gave half of it over for an annuity. Yeah, it feels like kind of mitigating the risk, doesn't it? Nobody wants to think you've worked your whole life and something happens to you in a year. You get cancer and you die and your kids don't get a penny of that? That doesn't feel right. But in our family with the longevity, pretty healthy, we don't smoke, okay, you've got the chance of living a long life. All right, so you get the point. Here's the scoop. What does the IRS want to know? They want to know how much that she's bringing, that Katie's cutting me on a monthly basis, how much of that is taxable. An annuity is an instrument that a taxpayer buys, usually at retirement, in return for periodic payments for the remainder of his or her life. The taxable portion is based on two things. How long am I projected to live? And the IRS tells me that. It's based on mortality tables. And how much did I pay in for the annuity?
Because you don't pay right until.
Till you start pulling it out.
Until after.
Right.
Oh, as you're pulling it out.
As you're pulling it out.
you pay?
Some of it's going to be interest.
Yeah.
Some of it's going to be a return of my own principal. Is that going to be taxable? No, heck no. I've already paid tax on that before I put it into my savings account, didn't I? Simplified method.
Sorry, isn't it like is it a specific percentage that you get paid every month, or do you set that when you buy it?
It's based upon how old you are when you buy it and how long you're projected to live. So if you buy an annuity, if you retire when you're 50, you're going to be projected to live statistically as a non-smoking woman another 32 years, right, to 82 years old.
So my payments are probably going to be smaller than
Sure,
I bought it when I was
clearly. 65, sure. Because then I'm still projected to live to 82, but I only got 17 years. Okay.
Can you buy it after you retire?
Sure, you can buy it whenever you want.
Retire at 50, buy it at 65.
Sure, absolutely. Okay, so the simplified worksheet, let's just take a quick peek, pages 2-12 and 2-13. I don't think it's that simple, but okay. It starts on the bottom of 2-12. You enter the total amount you received this year, how much you put into it on line 2, the age of the annuity at your starting date, so on and so forth. And it comes all the way down. It gives you an example then. We're not going to go through this line by line. I just want you to know it's here. And it's going to plug out a number all the way back on page 2-14 and say, you've got to pay tax on $15,539. We're going to use the general rule. We're not going to use the simplified worksheet. We're going to use the general rule. And in reality, I don't even know why we go through this, because in reality, what happens is that you get something in the mail at the end of the year called a 1099-R, and it tells you. It says, you got $24,000 in retirement income. And then it says in the little box next to it, taxable amount. So it's done the math for you.
Calculate that taxable amount.
It goes through what I'm going to teach you right now,
Okay.
and it gives you that amount. And there's an input screen called 1099-R on your tax software, and you put in the total amount and you put in the taxable amount, and it shoves it out to the taxable column. Should we see where that goes on our 1040? Where? Yeah. 16A is the total amount. 16B is the taxable amount. Okay. What does the math look like? Everybody with me? 16A and 16B on your 1040. This amount's going to go in 16A. This amount's going to go in 16B. Okay, so basically, as I said, when you get your payments, a portion of it's going to be taxable and a portion of it's going to be non-taxable. That's your return of your own money. That's not taxable. I'm getting my own money back. I gave it to her, now I'm getting it back. I don't have to pay tax on that. So you have to calculate the amount to exclude from income. And that's based on something called an exclusion ratio. And the way you calculate that, and this is pretty straightforward, investment in contract, in other words, how much money did I give her? How much money did I pay in the investment in my annuity contract? Divided by how much am I pulling out a year times my life expectancy. And again, the IRS tells me how long I'm going to live. Once you have the exclusion ratio, you multiply that by the amount that you pulled out, and that's the amount you exclude. So let's have a peek at the numbers. It's easier to do than it is to look at the algebra. Okay, here we got my buddy Din. He's worked in San Francisco his whole life. He's put away a chunk of change, $750,000. He uses it to purchase an annuity. He's going to get $4,800 a month for the rest of his life. And you go to the mortality tables at the IRS, and I'll give you this number. You're not going to have to look them up. I'll give you this number. The IRS mortality tables say, as a non-smoking male, he's going to live another 19 years. How much of Din's annual payments are excludable? And he's going to use the general rule. What's our first step? Calculate the exclusion ratio. You've got to take the amount that he invested in the contract divided by his annual payments times his life expectancy. So give me a percentage, please. Let's see, good question. 3. What'd you get, 68.5? What's the numerator? 750,000. The denominator is 4,800 times 12 times 19. Yes, of course you did, because you took the monthly payment and you didn't convert it to the annual. Don't do that again.
Okay.
Now you know that mistake, right? Very common mistake. And just for a reasonableness check, if you give somebody $750,000, you're not gonna get 4,800 a year out of there, are you? That would have been really horrific advice from an investment standpoint.
So then is he responsible for 39,456 on that?
That's the amount that's excluded.
From the tax.
The amount that's excluded from the tax. Tell me how much is included. How much of his annual gross 1099R is included? Well, I got to do the math myself here. Everyone get that?
And that's called a 1099R.
That's exactly what it is. 1099Rs report your pensions, your IRAs, your annuities, your distributions from your 401k. No, not self-employment. That's a,
No, I just meant it said 1099.
oh, yes, yes. Yep, 1099R for retirement, 1099 miss for prizes, awards, independent contractors. What's this one for again? Yep, and this guy's for your, yep, good. I'll throw a couple others up here that you need to be responsible for as well, as long as we're talking about 1099. That's when you sell a piece of real estate. Yeah, it's your sales document, so to speak. And when you sell stocks and bonds, the proceeds, in other words, what you got, is a 1099B. Those are your
Proceeds from what?
proceeds from the sales of stocks, bonds, jewelry, gold, antiques, anything that we track through capital markets.
How'd you get that taxable amount?
Where am I? So if 68.5% is excluded, 31.5% is included.
Oh, okay.
Yep. Good. If your employer has paid into a retirement plan on behalf of you, and then you start pulling out periodic payments from it when you retire, that's not taxable. That's to encourage employers to do that. The IRS has made that a non-taxable transaction. So y'all work for me, and I put in $150 a month for each of you over the 20 years you work for me, and now you retire and you start pulling that out, not taxable. So to encourage me to do that.
But the portion if you have a matching portion,
Yes.
if I provide.
Then we have to go
that
through the
part of it.
calculation. Yes.
Or whatever we put in.
So I have a question.
Yes.
The
Yes, ma'am.
dividends, the 1099 DIV.
Yeah.
Since capital gains and also they're taxed at the lower
Yeah.
rate, would you get one of those if you had, capital gains as well, or would you get the stocks and bonds one?
Great question. So you're asking about capital dividends?
Yes.
Is that what you're asking about? That would come on a 1099 DIV.
Okay.
And we are gonna, that packet that you bought at Mike's, that's what we're gonna be doing then, is start looking at all these source documents. For me personally, when I started doing tax, I didn't really struggle with calculations or getting it in the software, but reading those gall darn source documents, because they look different. They're not, it's not like there's a template. Every single realtor has or title company has a different a sales document for real estate, and every different broker has a different 1099B and INT and DIV, and they just were all very confusing to me. So that's what we're going to do there. Life insurance, you are the beneficiary of your mother's or your spouse's or your kiddos' life insurance policy, and they pass. He or she passes, and you get the money. Taxable? Specifically excluded in tax law.
Well, what if you leave it to somebody who's not moving
That's okay too.
and they
That's
don't
okay.
get taxed on?
No. If they're excludable, if they paid out to you because the person died and the beneficiary has an insurable interest. Now, sometimes life insurance policies are paid out over a couple of years. You can establish it like that. For example, if my husband and I were to die together, we wouldn't want our kids to get our life insurance proceeds all in 1 year. They're still in their 20s. We have it payable out in our will over a number of years. In which case, obviously, say it's $500,000. That $500,000 gets paid out over 5 years, so they each get $50,000 a year for 5 years. There's going to be interest then payable, right? Because there's money sitting somewhere. That's taxable. The interest is taxable, clearly. They're going to get a 1099 INT from the trust, the fund that the life insurance proceeds would go to. And then they're going to get some interest out of that, aren't they? So that's taxable. So for example, Karina dies on June 15th, and she leaves her husband Dan a $500,000 life insurance policy. The proceeds will be paid out to him $100,000 a year plus interest. So the first year he gets a check for $105,000. How much is taxable? Just the 5. Viatical settlements. This gets kind of tricky. I take a life insurance policy out. I've got a life insurance policy on myself. Let's say it's for $300,000. And I get cancer. And I'm diagnosed as terminal. Or I get ALS. And it's terminal. And I've got a doctor, 2 doctors actually, that are willing to sign that I'm terminal. I can take my life insurance, because it's pretty much like I'm going to die. But I need money because I don't want to have to go into an assisted living with my ALS. I want somebody to come into my home and take care of me. It's just a shill. Give you the example. But so what do I want? I want a piece of my $300,000 now to pay for the health care. That's a viatical settlement. And I can do that as long as I've got certification that I'm reasonably expected to die within 24 years, or 24 months, or I'm chronically ill, I've got multiple sclerosis, and I'm never going to be able to function at the level that I was before I was diagnosed. Then I can go sell my life insurance policy to a viatical company, and they become the beneficiary. They're not going to give me $300,000. They're going to discount it. They're going to give me $2 or $220 or $230. And then when I pass, they're going to get the amount.
Does it have to go to medical bills, or can you just take it?
I just get it to do whatever. It might not be medical bills. I might want to bring in a full-time nurse so that my husband can continue to live his life and I can stay in my home. Or I might take that $225 and go, you know what? Heck yeah, I'm going to go travel around the world for 6 months. You can do whatever you want.
Okay, that doesn't have to be specific.
No, nope, it's my money. These are called accelerated death benefits. The others, and they're not taxable either. Sorry. The other thing I can do with my life insurance policy is, well, I couldn't do it with mine because we have something called term insurance. Does anybody know what term insurance is?
Something over 20 or 25 years.
No, term insurance is as long as I keep paying the premiums, my life insurance policy stays alive. The minute I stop paying the premiums, it has no value and it goes away. The older I get, the more the premiums are. When we started paying on it when I was 30, I think we paid, $300 a year each. I mean, now it's like $1,200 a year each. Because we're getting older and the chances of us dying are getting higher. Okay. Term insurance is when you're done paying on it, it goes away. It's like all that money you paid all those years is just down the toilet.
Yeah, that sounds awful.
Huh?
That sounds awful.
Well, do you have kids?
I do.
You want to know there's something there if one or both of you die. And when you had kids at home, it took every penny of what both of us made to keep our house alive. So if one of us had passed, the other person wouldn't have been able to continue to provide for your kids. And that's what insurance is.
Okay.
It's mitigating risk. But yeah, you look back and you think, holy moly, we've been paying on this for 25 years. As soon as we're done paying off our house, we'll stop paying on it because we don't need it anymore. And then you think, boy, that was $100,000 I threw down the toilet.
But it's a lot less expensive than whole.
It's a lot less expensive than whole insurance. Whole insurance has two things to it. A piece of it is the insurance, and a piece of it is an investment. The thing about whole insurance is it stays the same no matter how old you get. So you lock in at 30, and we looked at it at 30, we couldn't begin to afford it. It wasn't any $300 per person a year. It was like $1,000 per person per year. Well, we didn't have that kind of money when we were 30, and student loans and daycare bills and car payments and all the stuff when you're starting out. We didn't have money like that. But what happens with this investment piece is it gets something called a, what the heck is that called? Oh, wow. This isn't really the term, but bear with me, it can describe it. It accrues an amount that whenever you terminate this policy, they pay you. Does that make sense? So this amount I've been paying in since I was 30, for example, into my whole life policy, and now we get our house paid off, we're done with the insurance, we don't need it anymore. There's going to be a face value to that, which isn't exactly the term, but close enough, that's accrued, and it's $11,396. And when I terminate my whole life policy, they're going to pay me that. When I terminate my term policy, I get nothing. I've just bought myself peace of mind for 25 years. When I terminate my whole policy, the piece of the payment I pay every year that goes into the investment, I get the cash.
Or it's a way to give something to your family after. as a
Certainly.
beneficiary.
Certainly. So, back to what we're talking about here. If I transfer my policy for value, that's what it is, cash surrender value. There's the term right there. Cash surrender value. It's not face value, it's cash surrender value. That amount, if I transfer that, so say I owe Stacy $11,000 and I sign over my policy to her because it's got $11,000 of cash surrender value, that's taxable. That's income to you. Okay, normally life insurance proceeds aren't taxable, but that cash surrender value piece is taxable if I give it to somebody. This isn't a common transaction. I've seen this once in 30 years of doing
If
taxes.
you loan somebody money and they give it back to you, then how do you get taxed on that when it was your own money in the first place?
Good question. So the example I was giving wasn't so much that I owed you money on a note,
Okay.
but you'd sold me something.
Okay,
And that was my way of paying you, compensating you for it.
okay.
Yeah, good question. Okay. I don't want to spend too much time on stuff that isn't common. You know what I mean? Okay. And I will test accordingly. I will test on things that I see over and over and over, and that's the stuff that I really emphasize in here. Like, lots of people get 1099 INTs, lots of people get 1099 DIVs. It's not like you've got to be super high net worth to get that. Okay, gifts and inheritances. Are inheritances taxable? I get this question all the time. No. Any inheritances are excludable from income. The actual estate, and this is way beyond our scope, so I'm not going to give you numbers or anything, partially because I don't know what they are anymore, but it's a ton. It's like, I think it's like 1.4 million per person. That anything above that, the estate pays tax on. Anything below that is basically a tax-free pass. If you inherit $5 million from your grandpa, that's all tax-free to you. The estate's going to have to pay some tax, but by the time it gets distributed to you, it's tax-free. Gifts, same thing. Say your grandpa is 85 and he wants to start gifting all of his grandkids every year. Can he do that? Sure. Anything beyond, I think, and again, don't quote me on this number, I think it's 14 grand per person per year. Anything beyond that, he's going to have to pay tax on. You don't have to pay tax on it. So basically what you need to know is that gifts and inheritances to the heir or the receiving party, tax-free.
So what if it was like the RV situation? You inherited an RV.
Tax-free.
You wouldn't have to pay the taxes on it? Okay.
But you do, because we had this happen with our son. My mother gave him, I think, about $14,000.
Okay,
And it was in stocks and bonds,
okay.
and there was a forced sale because the company went overseas.
Okay, you had to
Then we
sell
had-
the asset.
Yeah, and then we
You had to
pay
sell
tax.
the asset, then it's a taxable
Yeah.
transaction, but the 14 grand coming into your kiddo's name
No,
is
there
not a
was not,
taxable
if it was just
transaction.
sitting there, we wouldn't have had to do
No.
anything, but then we were for sale,
Yeah,
and
yeah,
we
yeah.
paid the tax on it.
Of course you did. Yeah, of course you did.
So if you inherit the RV or you inherit a house and you sell it, then it's
Then you've got a taxable transaction. The difference between the cost basis and the selling price is always taxable.
Is that just federal or is it state too?
State as well.
So why is this, I feel lost because it seems like there was always a big deal about.
There is always a big deal. And here's the big deal. The amount that an estate, so you're talking about people that are like land rich, like ranchers and farmers, and is that what you're talking about?
Well, that leave.
And they want to leave that to their kids, and there's all this hullabaloo that the federal government wanted a piece of it, and they were going to have to sell it in order to pay the tax, right? That amount, and again, don't quote me on the numbers, I've never really done estates and trusts. I've got a few, but I'm super not technically competent with them, and there's a lot to it. But the number used to be really low, like $200,000 or $300,000. Now it's like 1.4 million per person. So if you all are married and you're getting ready to die, and you've got this ranch, it's going to be fined up to 2.8 million on net value.
Oh, okay.
And but that number used to be low. That number used to be like 400 grand between the two of you.
So like, if my parents, there's 3 of them here,
Yeah.
left their property,
Yeah.
they just have like 6 acres.
Yeah.
And the house.
Tax free.
It is, until, but then we'd have to sell it to divide it, right? If
But
we were-
certainly, I mean, yeah,
If
whatever
I
you
keep
have
it,
to do
then-
next.
Oh.
Yeah,
figure
that
it
becomes,
in.
so if you've got 6 acres, are you gonna divide it up in 3 2-acre parcels? Then you're fine, you've each got ownership. What are you gonna do with the house? And that is, that's the big deal. What's usually beneficial is if somehow, say there's a house, and then there's the 6 acres, and then there's maybe a savings account. I mean, if one person can take the house, and one person can take the land, and one person can take the savings account, then you don't have to start selling stuff. When you start selling stuff, you do pay tax on it.
Is there a grace period or anything? I want to say my grandpa's mom died and they finally got all of it. And if they sold the house and split it between them within 6 months or something, they didn't have to pay taxes.
I can't speak to that, I've never heard that.
Our house-
That's not to say that it doesn't exist, because again, I'm not very proficient.
Well, I remember my grandma stressing, like, if they didn't get it sold by a certain date, they would have to pay
Mm.
taxes on the income.
Now, okay, 6 months in real estate, that does peak something. When you do something called a like-kind exchange, which means I sell my fourplex and buy your yacht, I sell my ranch and buy your, apartment building. When those are called like-kind exchanges, and you don't have to pay tax on that if there's 180, within 180 days of selling the first one, you buy the
Yeah,
second
that,
one.
it was 180 days.
It's a like, that's a like-kind exchange, and what that means is that they were selling one piece of property and buying something else
They were
like-kind.
investing it or putting it in something else. Okay.
That's what it is. You guys asked a lot of good questions. Okay, what time we got? Oh, great. Scholarships. Scholarships that you get to pay your fees, your books, your tuitions, that's all tax-free. If you get a scholarship that's applied to room and board, that's taxable. If you get a scholarship and you have to do something for it, like, well, I guess perform athletics isn't a good example because technically you're not supposed to be paid to participate in collegiate athletics, right? What would be an example? You got a scholarship, but for that you have to be photographed and featured in the brochures and the advertisements for this upscale private college in Maine. Okay? Then you're really being compensated for something, aren't you? And then it's taxable. That's not common. Really, again, I've never honestly ever seen
What
that.
about my GI Bill?
Not taxable. Really, the only time that I see scholarships taxable is when a portion of it is attributable to room and board, and that's broke out on the, I can't remember exactly what the 1099 is that those come through on. Oh, no, you know what it is? It's a 1098T. And you guys have all got those for your tuition.
But I never have to pay, like, I take my whole financial aid in my loan. So
Yep.
I never have to pay, even though part of it's supposed to be for room and board and I
Yeah.
pay rent.
Yeah. No. Because it's not specifically broke out, and it's not a scholarship.
And it's not like I'm living on campus in dorm.
No, and but the difference is too, it's not a scholarship. You're getting loans, and I assume Pell Grants. Those are not scholarships. That's financial aid. That's non-taxable. Okay, my employer does, in fact, University of Montana, pay my health insurance premiums. Is that taxable to me? No. The government wants to encourage that. So it's not a good example because the University of Montana is a nonprofit. But if I worked for, Washington Corp and they paid my health insurance premiums, they would get a write-off and it's non-taxable to me. So it's the best of both worlds. Yeah, that's what I'll have to say on that. Meals and lodging. I'm a firefighter, and my employer pays for my lodging and for my meals. It is excluded from income, the value of that, right? So say, maybe that's not a great example. Let's say that I'm a ranch hand in some really remote, up on the High Line, and there's no way I can get to and from work every day from the nearest town because the nearest town's 80 miles away. Okay, so my employer, my ranch employer, pays for my lodging on the ranch property and pays for all my meals. That's worth a lot, right? Say that's worth 30 or 40 grand a year. I don't have to pay rent, I don't need my groceries, right? Do I have to include that? In other words, does that come in on my W-2? No. If the meals are at the ranch, on the premises, they're solely for the benefit of the employer. In other words, my ranch employer is like, I don't want you having to try and go find food in the middle of the day. I want you here because I want you back out, right? And the lodging must be on the premises, and it's got to be a piece of the employment. In other words, this ranch employer says, you guys all apply, and 5 of you are like, no, I got to go home every night. I got kids at home. And Stacy says, no, I can live here on the ranch. She says, yeah, that's a requirement of the job. Then I don't have to pay tax on it. So that's a huge benefit, isn't it?
We use like a real life situation.
Yeah.
So my boyfriend logs, and he's logging out of time, he's being paid per diem.
Yeah.
That's where that comes in, like.
Absolutely.
Completely separate check, it's not.
Absolutely. He's not paying tax on that because it's a requirement, I assume, of being employed, being
They're
up in the
out there
woods.
within like
Yep.
2 hours. So is it required by the state that they pay them that?
No. Oh, heavens no. I am assuming that that's the way that the logging company recruits good loggers. Is like, they're like, I'm going to be staying up here in the woods. You've got to pay me per diem to be here, and you've got to provide some sort of lodging. Or if I'm hauling my little camper with me, you need to, kind of make amends for the fact that I can't, go home and be with my loved ones at night and on the weekends. Okay, what do we know about this? We've talked about this earlier. What is muni bond interest?
Interest off of municipal bonds, city, county.
Any government, right? Any government bond, state or county or city government bond, right? So taxpayers, and we just saw this earlier, do not pay federal income tax on muni bonds. So what they're asking us to do here is to be able to look and compare I'm thinking about investing in some bonds. I got a $10,000 inheritance. And I've got the choice between buying a 6% muni bond or a corporate bond that pays 8%. Why do I not just choose the corporate bond and walk on down the road? Yeah, this one's taxable and this one's tax-free. So how the heck can I compare them? I've got to get them both to an after-tax rate. This is my after-tax rate on this guy because I don't have any tax. Well, I do have state tax, but let's pretend it's a Montana muni, no tax. How do I make this calculation? You've got to know what tax bracket I'm in. So Gopal is in the 33% federal income tax bracket, and he's investing in a Nashville City bond. And he wants to know what other kinds of bonds will yield the same after-tax return. The calculation is the 6% divided by 1 minus the tax rate. So can you find me what yield on another bond is going to pay in that same 6% after tax?
What's the calculation again?
It's the rate, the 6%, divided by 1 minus the tax rate. 100% minus the tax rate. So basically, what are they saying?
If you want to do like a corporate bond, it's going to be.
Yeah, it's got to be 8.96% to give me what I'm getting from my muni bond because I don't have to pay tax on my muni bond. So do you now see why the federal government makes muni bond interest tax exempt? Can you express that?
To help socially the local government.
Exactly. It's a social policy to help local governments. They can issue bonds at way less percentages. And then they're competitive with other bonds that pay much higher yields. Are you with me? So what am I saying here? My 6% bond, we just signed 2 huge bonds in Montana, Missoula, didn't we? School bond for $145 million and an open space bond for $48 million. Now the library bond's coming up for 30, but everybody's saying we've got bond fatigue and it's going to be really hard to fund our library. But at any rate, the city of Missoula got to issue those bonds at a much smaller rate because they're tax-free. But people still want to buy them, right? Because of this. Obviously, the higher your tax bracket, the higher this number's going to have to be. The lower your tax bracket, the less attractive muni bonds are. That's just the math, right? Unemployment. Unemployment is taxable fully. It is not taxable in Montana. On your Montana manual recap, you will see that as a subtraction. It shows up in your federal AGI. It is not taxable for Montana. Okay. Fringe benefits. Okay, let me see what number we're on here. What number? 37. I am gonna stop now. It's 11:08, and I'm gonna finish up these 5 slides or 4 slides on Tuesday because I want to give us time to go through our tax returns.
We get the printer to work.
No.